Hello, my friends. Welcome to the financial capital of the West, the land bountiful, where Brian and I are located, and Logan, where Spencer is, and Ely, Montana, or Greeley, Colorado, where Mike is.
No,
or maybe just down
the
in
other direction. Ely, Nevada,
Ely, Nevada.
practically.
Great to have everybody on today. I'm excited for today's conversation. Thanks everybody for joining us. It's been a fun week and a fun start to the year, my friends. We're going to talk about the start to the year. We're going to talk about what we don't know, which is important to understand, and the biggest risk that people face to making money in the market. So that's what we're going to talk about today. Before we do, Chairman, we're going to look at the overall market.
That sounds great.
I'm going to bring up two charts. First off, the chart in front of you is Mike Follett's favorite chart, and that is the CNN Fear and Greed Index. And look where we are, boys. We're fearful.
Fear.
Has it gone up? That's down as far as it was.
I mean, right? 1 year, look at this. 1 week ago, we were at greed.
Oh, wow. Okay.
1 year ago, we were at fear. We're back to fear, my friends. Brian, what did Warren Buffett say about fear?
Yeah, he says, be greedy when others are fearful. And then on the flip side, be, let's see, what does he say?
Be fearful,
when others are greedy.
When others are greedy. That's right. Be fearful when others are greedy. Yeah.
That's it. We're fear right now. And I bring that up just so everyone gets a sense for what the market is. And as that dial goes closer to zero, more opportunities come in the market as far as great businesses to buy at great prices. So I am not opposed to seeing that go further left, which is closer to extreme fear. So, which we were back in March and April of last year, which we may get to at some point this year. But that's the sentiment right now in the market is fear. And if you look at this is the best part about it. You come over here and you say, okay, well, what's the market so far this year? Well, the S&P's up 0.87%. The NASDAQ is down 1%. But we are in fear mode. Does it make sense to you guys?
Yeah.
I think a lot of people live their lives in fear. So, yeah, it doesn't, a little volatility.
Yeah. Yeah. So here's the other part of it is from where our all-time highs, the S&P's down 1.1%, the NASDAQ's down 4%. So there has been a little bit of sell-off. We have more opportunities to buy. Mike and I have been buying for the past couple of days as good companies have come on sale. But it's important to realize a couple things. First off, February is always a terrible month. Historically, October is the worst month of the year, and February is the second worst month of the year. So this is not a surprise. And the other thing is, Brian, you mention this all the time, and Spencer does as well, and that is the annual kind of pullback in the market from its highs is 14% on an annualized basis. So that's normal market behavior.
I think that's something. Yeah, I think that's something people should just automatically expect, that there's going to be a pullback. And on average, like you said, 14% is the average, which means, we always talk about this. 14% is the average, but average, we never do the average. It's either more or less than that. So
yeah, last year was more.
Right.
Yep. So prepare yourselves. And that brings up this next point, which is important for everybody to understand, to prepare their minds. And that is simply this. Last year, we had how many new all-time highs, Spencer? Will you look for that real quick? How many all-time highs did we have this year or last year? Because we hit a new all-time high this year. And when we hit all-time highs in the market, what's the probability of us clients hitting all-time highs in their portfolio?
I mean, it's pretty high. It's pretty high. Yeah, generally that
38 times in 2025.
So we hit 38 new all-time highs last year. We hit another one this year. And I want to bring up something with that in mind as portfolios continue to make new highs. And as portfolios continue to make new highs, people begin to see new balances that they've never seen before. Wow, I cracked 1 million. Wow, I cracked 2 million. Wow, I cracked 10 million, 20 million, whatever that is. And people become anchored to that number. Mike, this is what I said early on. What is the most dangerous? The dangerous risk to a client's portfolio is themselves. That's the risk. It's what's in between their ears. So tell me, what does it mean to be anchored to something, and why is it dangerous?
Well, when you think about something that's happened recently, a new high in the portfolio, you tend to become centered around that and only think about that. You kind of lose track of, you said it just a second ago, you lose track of the fact that in the last 3 years, you probably experienced points where your portfolio's fallen, but then patience allowed that portfolio to go up and set a new high. So when you get to those new highs and the market pulls back or the portfolio drops, we tend to anchor on that last high. If we think about the previous times, that's no big deal. It's like, hey, it's been warm outside and now there's a shot of cold. Let's not freak out. It's just something that we're not used to necessarily. But what it can lead to are some really kind of interesting behaviors. For me, a big way to understand this is you kind of lose sight of the big picture. Myopic loss aversion is kind of something that happens. And that tends to lead people to start making adjustments based on that old high, where the portfolio was, and now how they're feeling emotionally as a reaction to a bit of a drawdown. And the problem that you run into is you make adjustments that if you step back and think about it, I'm going to sell out or whatever. If you'd done that in the past, you never would have gotten to where you are now, right? Or where you got to in the last portfolio high. So it's very important to think about, okay, what were the behaviors that allowed me to get to the new high in my portfolio? And now that I'm experiencing a little bit of drawdown, a little bit of pain, what do I need to do to center myself to avoid making stupid decisions based on the pain of the moment, if that makes sense?
Yeah.
But, there are some strategies that you can actually think about that allow you to overcome that, right? Have you ever heard of the blank slate strategy?
I've never heard of that. Brian, have you heard of the blank slate?
No, I haven't.
You have, because I've actually heard you guys mention this thing within the last couple of days, because we spent a lot of time talking about our portfolio, right? But it's basically you just try to clear your head of everything you can and think, if I didn't own this business right now, right? Let's say I'm coming to this not knowing that I might be down 10% or whatever, but if I didn't own this business right now, would it be a good enough business for me to buy today? Right? Yeah. So start at the blank slate. Is this something that I would buy now if I didn't own any of them? And that's a great way to center yourself. That's something that we think about a lot. I know the last couple of days we've had some pretty significant conversations about that.
Yeah, we did, and that's an important investing principle, right? If we liked it at 100 and now it's at 90, we're going to even like it more to buy. Brian, I know you get phone calls, and I know one person in particular that used to call you, and I don't know if he does still anymore, but you get phone calls when a portfolio hits 5 million and then goes to 4.8 million. And the guy's freaking out saying 5 million is all I ever needed, and now it's gone. What do you tell people when you have that conversation? We had that conversation yesterday with the client. What do you tell them?
Yeah. I mean, I really like what Mike said about, not anchoring and kind of having a blank, clear slate. I think it's really important to understand why your portfolio grew to 5 million. Again, just kind of reiterating what Mike has been teaching us. The reason why your portfolio has grown to 5 million is because you were focused on the long term. You didn't panic when we had a market correction. And the other thing I always tell people is I say, let's pull up your portfolio. Let's look at the companies we own, and let's ask ourselves, do we feel confident in these businesses over the next 3, 5, and 10 years? And if that's the case, then we should really hang on to our investments, because the reason why we've had success is because we've let our businesses grow. We've let them operate. These are great businesses, and we've let them do their thing and grow in intrinsic value over time. And if you're trading in and out of stocks, it's very difficult to allow your businesses to grow over time.
Yep. Amen. What did Charlie Munger say about compounding your wealth? He probably said something like this, and this isn't a direct quote, but he probably said something like, don't be a moron and sell your stocks, because you'll screw up the power of compounding your wealth, which, Spencer, that 5, how does that 5 become 10? If you're so anchored to 5, right?
Did you just quote Charlie Munger by not quoting Charlie Munger?
Hey, the actual quote, I remember Buffett, actually, I think it was from Buffett. He said, if you're going to do something stupid when you own stocks, and he defined what that was. If you're going to sell stocks when they go down, then you shouldn't own stocks.
Then you shouldn't own stocks.
Right.
Yep.
So yeah, Spencer, I did.
I just wanted to make sure that was the case. But
Munger. Any thoughts on anchoring to a specific portfolio value or account value, Spencer? That's important.
No, it's so easy to do. I mean, we talk about different clients, and I remember a newer client with us, a few years ago, when she'd only been with us for a year or two, and her account had grown to $1 million. And she told me, Spencer, I wake up in the morning, I look at the Schwab app, and I'm either happy or I'm angry that day. And I was like, okay, this is not healthy. We need to have a conversation. But it literally, she had broken $1 million, and then the market kind of just jumped around a little bit for a month or two. And some days she'd be just over $1 million. Some days she'd just be under $1 million. And so I encouraged her to be aware of it, to look at it once a month. But whether she looks at it every day, it's not going to change what the market's going to do. And ultimately, that ended up working for her. So she's aware of it, but she's not watching the daily movements, because it started to impact her emotions and her day. Like literally, it impacted her temperament. And all of these things, it's important to have an awareness of it. But if it's impacting your day, then man, you got to have a much healthier relationship with it, especially when we're looking at money that's further than 2 years out, right? If you're going to use this money within the next 2 years, okay, we need to have a conversation, because it shouldn't be in the market. But if it's longer term out of that, all of this is just noise. The ups and downs and the daily movements, it's noise. I hate to say it to people, but it just doesn't matter.
And markets don't, and stocks and markets don't know that you own their stock or that you're in the market. I mean, the markets don't care, right? I mean, they don't know that. So it's kind of funny.
But we all do it. We all do it. We've all seen an account, and we've all done it. So it's very normal human behavior.
Sure.
Here's a chart right here of the S&P 500, which you can see on this screen. And what's kind of the theme throughout here is higher highs and higher lows, right? The ups and downs. And this is up. I mean, from a percentage in the last 10 years, you've got a NASDAQ up near 500%. But look at all the highs and the lows. And so you just have to ride that out. Not just write it out, but also take advantage of it. So, yep, I love it. I love that concept. It's important to not let two things control your happiness. One, politics, which we don't need to get into. If that dictates your happiness, you got some issues. The second thing is you're a portfolio value when you're invested in stocks. You got to just let it compound over time. So, and I know that was a Munger quote, and I'm going to find it. I may have added a word or two, Spencer.
Hey, I believe there's a quote out there, but I thought it was funny. I'm going to quote Charlie Munger, but it's not, I'm sure, I don't know if he said this, but okay, he probably didn't say this, but he said something like
close.
Yeah. I love it. All right, let's go to an important principle that we've learned this month, really, that we've followed for 26 years. Brian, you came up with this. We follow it as a firm, and that is one of our core principles is we don't invest in things that we don't understand. Okay, so we're going back and forth on a specific software company this week to buy. Spencer, will you summarize what we just went through as an investment committee, and then Brian, explain why it's important to have that as a one of our 4 core principles in buying things. Spencer, what have we done this last week?
So as an investment committee, we all come together and have different ideas of different companies that potentially meet our criteria of we understand them, they have durable competitive advantages, they're run by people that we trust, and then the valuation side of it. And so we get together and we debate these things over and over and over. And sometimes we're complete alignment and sometimes we're not. But a company that I would say that we've been talking about for, I don't know, 3 months. I think we've all been following this company probably for years and years and years, but probably for 2 to 3 months have been debating it. And a decision was made over the weekend of, hey, we think we're going to take an allocation to this business. We think it's at a price that's attractive. It has the 3 criteria based on the information that we had at that point. It had that three criteria. And we had debated about it and ultimately made the decision to buy that company during this week. Now, through the process of starting to buy it, we also had some new information that came out that had to make a step back to say, do we really understand the competitive advantage? Price at that point does not matter if it doesn't meet the 3 previous criteria, and specifically to the competitive advantage that it has. We found out some new information that made us question, okay, does it have a clear competitive advantage? And I think currently the answer would be we don't know. And if we don't know, the conviction's not there to buy it. So that's ultimately what happened. I think, was that good enough summary?
Yeah.
That's a great summary. We looked at this company. You remember this, Spencer, about 3 years ago?
Yeah.
We talked about this company and we decided not to buy it back then because of the valuation. But now recently the valuation started looking attractive and it got our interest. And then about 3 or 4 weeks, like you said, about 3 or 4 weeks ago, we looked at it, but it wasn't quite where the price wasn't quite right. Then recently the price looked pretty attractive, but yeah, you had a great summary there.
So from the aspect of this business, it has to do with AI and the changing nature of AI. Okay. And we love, and we have some great investments in the AI world. I mean, it's a super cycle. I don't know where we are in that cycle, but it's pretty darn exciting what's happening. But here's the thing that we saw, Brian, you can speak to this as well, is AI technology is changing pretty fast, like super fast, to where we saw, what did we see on CNBC today, Brian, with the news anchor?
Yeah, this was a non-technical. She didn't really have any coding or software writing skills, but she was able to get onto Anthropic's Claude and able to design a brand new software package that helps her with her daily organization. And she said she did it in a half hour, and it's very useful. And it just kind of blew our minds, like, wow, the technology is pretty impressive. You and I, we talked about going through the .com era and the technology back then, and then compared to today, I don't think there's any comparison. The technology that changes and the speed of change right now is I've never seen it ever.
And from a being able to code and write our own software, Mike, do we know how to do that?
No, but apparently if you use vibe coding or
You can.
whatever it's called.
Yeah.
It's pretty amazing technology.
Hopefully we'll learn. Spencer, I think you coded a whole thing the other day, didn't you?
No, I didn't, but I'm learning about vibe coding, and it does it changes competitive advantages, right? To take someone that has to have this skill set to be able to code. And there's still a lot of questions about security with it and all of that kind of stuff. But to take software platforms that have this written code, that have, hundreds of employees that are working on this, to then have one, Claude who can write a program for you. And I'm sure it's got to improve in some ways and all those things, but I've watched a few videos on it. It's fascinating. And so you realize how quickly a competitive advantage, how quickly it can change from durable to non-durable in this environment, especially in the tech industry. So you have to be very, very careful. And that's why that criteria goes in. It doesn't matter how cheap something is if it doesn't have a competitive advantage, or we don't understand it, or we don't trust who's running it, because at that point it doesn't matter. So, yeah, I think you have to be really nimble and aware. And I think for us, that's follow the process. And the minute we feel like we don't have the conviction behind one of those three criterias, look. Don't chase a bus, don't chase a stock, don't chase a deal. Another one's going to come along, and you're much better off having the conviction behind what you're on.
I love it. I love it. Don't chase those things. So we took a step back because, number one, we didn't fully understand the impact of Claude and Vibe. And to be honest, we don't fully understand what those things can do or how they work. And so what do? For 2 hours last night, I'm watching videos on how they work and how to do it, right? To gain the understanding. But if we don't have that understanding going in, and we don't recognize the competitive advantage of a business that we don't truly understand, Brian, from a risk standpoint, how's that clearly associated with risk and controlling risk for our clients who we manage money for?
Yeah, I mean, it's really about preserving capital. And so if a stock, almost every time we buy a stock, at some point it'll go down. And you got to have that conviction. You got to have that faith and conviction that if the stock does go down, we're willing to buy more at a cheaper price. And when you lack that conviction and you don't truly have that understanding that you need to be able to step up to the plate and buy more stock when the stock goes down, you shouldn't be in that stock. I mean, you shouldn't own it. And the number one rule in our investment process is making sure that we understand the business. Do we truly understand the business? Here's a case where we thought we understood the business, but then new information came out and we thought, well, maybe we don't. And
it's interesting, Brian, because we've had a couple situations like this. I still think we understand the business. I think the industry is changing. It's the bigger box, right? I feel like I have a very good understanding of that business. I know you know it even better than I do, but it's the fact that the industry is changing, and that's where that competitive advantage, you're like, man, how is that industry changing, and do they still have that? Does that advantage even exist in that new industry?
Yeah, well said. I think that's 100% right.
So there's three reasons why we would sell a stock, right? One is it becomes too overvalued and we like something else, so we're going to sell it. That's one reason. The second reason would be, well, that same thing, right? If we're just selling the allocation down because it's become too big of a portfolio, and so we're selling it off of a little bit. And the third reason is if we're wrong. And you have to know when you're wrong quickly, because a small loss is just that, small, and can be overcome pretty easy. But if you don't admit that you're wrong, or that you don't know, or if you're too prideful in keeping with that investment because, I'm so cool or whatever it is, and I'm so smart, then that loss can get out of control and be very, very hard to make up.
Hey, can I give you a quote?
Only if it's Charlie Munger.
No, it's Stan Druckenmiller.
Oh, hold on. Spencer's man crush, Stan Druckenmiller.
Just go listen to him, and you'll fall in love as well.
Who has taught Scott Bessent and the new Fed,
Kevin Warsh, who works at
Kevin
Duquesne.
Warsh, the new Fed president, at least, maybe, hopefully, probably. Anyway, Stan Druckenmiller, the teacher, the investor extraordinaire.
Two quotes for you, okay? It's not whether you're right or you're wrong, but how much you make when you're right and how little you lose when you're wrong. That's number one. Ooh. And then second one, cut losers fast, press winners harder. And yeah, no investor is going to be right 100% of the time. Now, a famous thing from Stan is he's never had a down year. I mean, we're talking about like a 75-year-old dude that's never had a down year in the market for his portfolio. But it's part of that is recognizing when you're wrong and getting out as immediately, instead of trying. So many investors make the mistake of, I got to get back to even. Okay, I got to find a way when it goes back up to even. Cut your losses, stick with your winners.
You know what you just described when you said getting back to even? That's that anchoring effect in another way.
Yeah,
right.
We just went full circle haiku.
Full circle. Amen, brother. Mike, anything to add to the process? Now let's set the table here. When I ask you this question, you're newer to the investment committee, right? And you've been in the industry for 30 years. So what about that process and ditching things that we don't understand and keeping losses small and everything that we've talked about? Any thoughts to any of that?
Yeah. So thinking back on the last couple of days, I think the most unique thing that I've experienced is just the conversations. The fact that we're bouncing ideas off of each other and questioning one another's thought process and picking it apart in a respectful way and eventually coming to a consensus, right? That's quite a process. It's a good team you've got here for sure.
And I appreciate that, but Brian didn't need to make those derogatory remarks about my mother after I talked about the stock he liked.
Now, this is a true statement. At the very end of the meeting, I had to tell Spencer, I really love you, brother.
Spencer, hey, do you want to know what
that did happen?
That shows all our listeners Brett has a good conscience. Hey, I was on the court with so many teammates. You were yelling and angry at each other or whatever it was. And then you got to the locker room and you were fine. It was like, I mean, I don't know if that was the way it was for you, Brian, on the field. On the football field, you probably fought like heck. But you get to the locker room and you're showering, you're joking around, and everything's good. I love Brett. That tells you Brett is a good person because he felt like he had to tell me he loves me.
I appreciate that. I'm sorry about those things I said about your dog. And anyway, the process that we've had in place for 26 years, the 4 criteria. We know that if we're disciplined to it, that we won't win every time. Every position we take will not be a winner, but we know as we follow it and we're disciplined to it, that ultimately our clients will compound their wealth and become anchored to new numbers every 3 to 5 years or whatever it may be, and they'll accomplish their financial goals. And that's the most important thing to us. So with that, The first rule of compounding is never to interrupt it unnecessarily. That's the Munger quote. I threw the word moron in there. I apologize for that, Spencer. With that, any other thoughts, my friends?
Good discussion.
Yeah.
Okay. We've got some research to do on how to create our own AI chatbots. So we're going to go dark for a while. Until next time, my friends, thanks for listening. Bye now.